Hey everyone, Luca here, thanks for jumping into another video. Today we're diving into the latest FOMC meeting and how it's going to affect the markets moving forward. So if you're enjoying content, don't forget to give this video a thumbs up and make sure you subscribe to the channel so you never miss out on future videos like this. Now let's get into it. So in their latest FOMC meeting on Wednesday, we had their press release in which they said that beginning in April, the committee will slow the pace of decline of its securities holdings by reducing the monthly redemption cap on treasury securities from 25 billion to 5 billion. They also said that the committee will maintain the monthly redemption cap on agency debt and agency mortgage-backed securities at 35 billion. So essentially what this means is that they slowed down their quantitative tightening measures by 33%. So from a total of 60 billion to a total of 40 billion. Now, of course, this is positive news for the markets as it clearly signals where the monetary policies are headed next. But in my opinion, it is not that big of a change as the quantitative tightening still hasn't ended yet, which is something I've seen a lot of people discussing as they saw this massive reduction from 25 billion to 5 billion, which represents an 80% reduction in their monthly redemption cap. And so they sort of said that the quantitative tightening period is over, which is clearly not the case, unfortunately, but rather it is more of a transition towards the end of quantitative tightening. Now, moving to the CME group, specifically the Fed watch tool, we're seeing that there is a 67% probability that the Fed will cut rates in June. So the markets are currently pricing in rate holds until June, which in my opinion will represent a very important step for the markets moving forward. Now, in May, the markets are pricing in yet another hold, and in their latest meeting, the Fed, as expected, has held their rates once again. But now, I want us to move on to another statement in their latest FOMC meeting. So on X, I made a short thread covering a recap of the FOMC meeting in which I highlighted one of Powell's statements regarding tariffs, that tariffs tend to bring inflation up. Now this is normal due to the fact that tariffs equal higher prices as companies pass costs to consumers. But if consumers were really struggling, demand for that particular product would simply drop. So my argument here is that Powell's comment may hint that consumer spending power remains strong even with the recession fears we've seen for the past weeks. As if we track the Google Trends, we'll find out that recession fears and recession searches have reached their highest point since the macro bottom in the markets of 2022. So because of that, going forward, I'll be focusing more on microeconomics and household data as I believe it could provide some clarity into the Fed's future monetary policies. Next, I want us to have a look at a very interesting confluence between the Bitcoin's price action and the United States interest rate. Now, going back to 2022 and 2023, we see that while the Fed was adopting a full-on quantitative tightening program to combat inflation and they were raising their rates, Bitcoin was in this 1 year plus consolidation range in which the price essentially did nothing but to chop until it eventually broke out. Now, what was the main catalyst for this breakout? Well, I believe it was due to the economic certainty and in rising investor confidence. Now, this was when the Fed had actually held their rates for a few months, exactly 3 months. So from July of 2023 to October of 2023 when this rally started. So The argument here is that in current times, we're seeing something very similar between the rates and the Bitcoin's price action. So now we're essentially 3 months into rate holds, and as I mentioned earlier, it is expected that for the next 3 months the Fed will continue holding their rates, which in my opinion will lead to a similar risk on environment to the one we've seen in 2024 when Bitcoin had this massive rally from 25k all the way up to 75,000. And again, the argument here is that when monetary policies are predictable and when there is a stable economic environment, investors tend to get more aggressive in their investments and their risk appetite increases, which is why we see a transition towards risk assets, and so risk assets outperform traditional assets. So this is my main argument here, and I believe that once the Fed will continue to keep their rates still for the next few months, so until June, okay, we have this until June, I believe that will lead to a midterm risk on environment in which Bitcoin will once again resume its uptrend. Now I'll soon make a video regarding my views on a potential cycle top moving forward, so make sure you stay tuned for that as well. Now going back to all the way to 2019, we'll find out something really interesting, which is that we had before the pandemic, we had a very similar environment in the markets. But the main argument here is that the markets were in a downtrend, Bitcoin as well, and then the Fed held the rates still and essentially led to a similar risk on environment on the midterm, in which we've seen this V-shaped reversal that also preceded the pandemic. So when economic times are stable and monetary policies are predictable, the markets tend to rally. When economic times are uncertain and monetary policies are not easy to predict, then the markets transition towards safer investments, which is why we've seen gold reaching $3,000 for the first time in its history a few days ago. So this is my main argument for Bitcoin right now, and this is the correlation I'm currently making between the stock market, the Bitcoin, and the interest rates, which is why I say that tracking monetary policies is so important moving forward. Now moving to another chart, I want to show you the correlation between risk assets, traditional assets and equities, and the total assets from the Federal Reserve. Now the total assets highlight what the Fed actually owns and essentially represents the liquidity they inject into the financial system through their purchases of bonds and different other securities. And this is how they, again, inject liquidity into the financial system. Now, over the past few years, we have seen small caps, as we can see here. This is the IWM divided by the S&P 500, which represents small caps divided by traditional equities. We've seen small caps underperforming relative to big caps over the past 4 years. And this applies to the majority of risk assets, including altcoins and others that we'll have a look in future videos. But for now, I want us to focus on the broader concept, which is why have risk assets underperformed relative to traditional assets. And so we've seen small caps massively underperforming the S&P 500 due to the fact that the total assets has gone lower because of the quantitative tightening measures. So the main argument here is that risk assets simply cannot outperform traditional assets while there is a tight liquidity environment. Okay, now back in 2021, when the Fed was printing, as we can see here, there was a massive spike between the small caps and the traditional equities, as they started to massively outperform them. But since then, since the Fed started to raise their rates and started to sell their treasuries and other securities, things have gone south for small caps. And this is one of the main reasons why I believe also Bitcoin miners have underperformed so massively over the past few months, because this is essentially a macro thing, not just a sector related issue. But the point I'm trying to make here is that once the Fed will end quantitative tightening measures, which is of course soon, in their latest FOMC meeting, they hinted towards somewhere in the middle of the year, somewhere in the summer of 2025, that they'll end quantitative tightening measures, when their total assets will bottom out and start this bottoming formation. I believe this will be bullish for the risk assets, especially on the midterm. I believe that will eventually lead to a short or midterm distribution into risk assets, which we'll talk on in a few upcoming videos. This is where the long-awaited alt season will also begin. But I believe that the main catalyst for that will be the end of quantitative tightening. Until then, risk assets will most likely continue to underperform their peers. And this is just the reality we have to face. Risk assets and small caps and altcoins have been essentially in a 4-year bear market. So it started in the March of 2021. So they have been in a 4-year bear market against traditional equities. So things, until it is a macro change, will not shift all of the sudden. I don't believe that this will bottom out until there is a macro catalyst that will make this bottom out. So this is the argument I'm trying to make here. And again, it deeply affects how altcoins perform and how small caps perform relative to their traditional peers. Moving forward, I want us to have a brief discussion about the current state of the markets on the short term. So as you can see here, we have the S&P 500 that has dipped below its 200-day moving average. Now, because it has, I'm currently more cautious, especially on the low time frames in the markets, until we can reclaim this and take it as a support and potentially continue our rally. Now, a similar thing happened back in 2023 when we also dipped below the 200-day moving average. Then we consolidated for a few days before we eventually continued the rally. But until we have a clear confirmation of a reclaim, I'm more cautious on the low time frames on what concerns stocks, equities, and Bitcoin. So this is something I'm currently waiting for, whether this is a deviation or a solid breakdown. I'm currently waiting on a clear confirmation before I make any decisions. Moving to Bitcoin, I'm currently tracking two potential outcomes right now. The first one would be a bullish reversal that would invalidate my current bearish thesis and my concerns of a potential leg down on the lower time frames. So this would be what I'm currently waiting for, to see if Bitcoin can reclaim this resistance range and take it as a support to bounce then even higher, or if we fail to break this resistance range and we have another leg down on the low time frames before we have any sort of reversal to the upside. Now, the reason why I'm saying this is because we're currently following a similar pattern to the one we've seen back in early March and in late February regarding a series of untapped lows that has been forming on the low time frames. Now, essentially how this works is that we have a series of bounces back and forth that form higher lows and higher highs each time and make retail really bullish, especially on the low time frames. And so the series of untapped lows, how this works is that traders, when they want to enter a trade, they set their stop loss at the nearest support point, right? At the last support point. So for example, if I want to enter a long position here, I would set my stop loss over here. Or if I want to enter a long position right here, I would set my stop loss here. Now, unfortunately, what this series of untapped lows does is that in the case of an event, of a news, if it is a bearish announcement, then all of these untapped lows and all of these stop losses tend to get triggered all of a sudden, essentially leading to a liquidation cascade. Now, we've seen something very similar in early August when Bitcoin dropped by around 30% in a matter of a few days, and we've seen something really similar here in early March and in late February. As we can see here, in early March, what preceded this correction was, again, a series of untapped lows. So, as we can see here, there was this series of 3 untapped lows before we had this correction. Going back to late February, as we can see here, again, there was a series of 3 untapped lows that formed, which led eventually to this liquidation cascade, until the trend shifts and until we have a clear confirmation that we're no longer in this downtrend that has started back in January, and we're no longer into it, but rather that we have shifted it, that we have changed the market structure, that we succeeded to form a higher high, right? As we can see here, until now, we only formed lower highs each time. So each time we formed a lower high. And so until this changes, I believe that there is no actual reason to get overly bullish, especially on the lower time frames. So this is what I'm currently tracking. Again, if the S&P 500 succeeds to reclaim its 200-day moving average and Bitcoin succeeds to reclaim this resistance range's golden pocket between the $86,000 and $88,000 level, then I would once again get bullish on the low time frames and get into long positions. But until then, I will keep a more of a cautious approach. Hope you find these videos valuable. These are my thoughts on the latest FOMC meeting and on the current state of the markets. So if you enjoy similar videos, make sure to hit that thumbs up button and make sure you subscribe to the channel so you never miss out on future videos like this. Thank you all for watching. See you all in the next one.